We're joined by Tom Lydon, CEO of ETF Trends. Tom, always great to have you here with us. We've got a lot of big tech earnings out this week. Curious to know if you think that really right now is a good time to get back into some of those big tech names. We had seen a lot of rotation out of that sector throughout the first half of this year.
Well, if it's any indication of the flows that we're seeing on the ETF side, it's all green, Chris. And I'll tell you, we just surpassed last year's flows into ETFs, which was $509 billion. We're now at $520 billion for 2021. A couple key indicators, though, are this. Last year during COVID, we saw a lot of thematic ETFs get a lot of attention. A lot of work from home stocks did very, very well. We've seen a shift back to the FANG stocks that make up, as you know, a big part of the S&P 500. As we see them reporting this week, the FANG stocks, along with Microsoft and along with Berkshire Hathaway, make up 25% of the market capitalization of the S&P 500. And they, again, have taken charge and taken the lead where most investors out there have a very high correlation to the S&P 500 and continue to believe that these are going to be the leaders in the future.
So, Tom, where are investors pouring that money? Where are they seeing opportunities at the moment?
So a couple things that are different than last year, Alexis, are this. Most of the money went into fixed income ETFs versus equity ETFs last year. So far this year, we've only seen 25% of the money flowing into fixed income ETFs. And a lot of that has to do with fears about inflation. After 30 years of declining interest rates, most investors don't feel that rates can get much lower. An indication of higher prices right across the board with commodities has been a little bit fearful for those investors that are close to retirement or in retirement, to the point where a traditional 60-40 allocation, 60 in equities and 40 in fixed income, has now started to shift where people are taking some of that dead money on the 40 side and shifting over into areas like dividend ETFs, where you can actually invest in some fairly valued ETFs from a stock standpoint, but actually get a decent yield, even better yield than the 10-year Treasury.
You know, we've heard a couple of folks tell us right now that we've really hit peak earnings growth. Some folks talking about the economic slowdown, at least in terms of economic growth throughout the second half of the year. And when we're looking at valuations in markets right now, some of them are pretty pricey right now. Where are you seeing really a lot of room for opportunity, perhaps some ETFs that folks should really start jumping into?
Yeah, if you're concerned about valuation, and we survey advisors every week, that's their second biggest concern. Their first concern is inflation. And if you look at your portfolio and you don't have any inflation hedges, even though the Fed chair is signaling that we're not going to be concerned about inflation going forward, most advisors don't believe it. The largest commodity-oriented ETF is the Invesco Optimum Yield Commodity Strategy, PDBC. That's something to consider, up over 31% so far this year, and it doesn't seem to be pulling back anytime soon. If you do feel that rates will be higher in the coming years, yes, banks do better with rising interest rates, but more importantly, regional banks, because most of their earnings are tied to lending. The SPDR S&P Regional Bank ETF KRE is something to think about. If we see a 1% increase in interest rates, those regional banks are going to do very, very well.
Speaking of the Fed, Tom, of course, their meeting is tomorrow. We've got Jackson Hole with the Fed chair in September. But let's deal with what's before us first. What are your expectations for tomorrow? And did you see any sort of investors jockeying for position ahead of the Fed meeting this week?
I think, Alexis, it's going to be more of the same. The Fed has been pretty consistent with their messaging. And they're hoping and maybe crossing fingers that their predictions are going to come true. I got to tell you, I am surprised that the Fed chair is sticking his neck out a little bit more, because we continue to see higher prices across the board in grocery stores, at supermarkets. Housing prices are continuing to be very, very high. until we see some indication of any pullback in those areas, and then also the labor markets, you and I are all concerned with going out to restaurants and not having enough service staff, hotels, we're seeing some bad reports. You got to get people back to work. And in order to get them back to work, you got to pay them some more money. That's all going to affect inflation as well. So at this point in time, I think the message is going to be more consistent. But come fall, we're going to have to see some pullback in inflation, or the Fed is going to have to take action.
Tom, I want to ask you just about the Delta variant before we let you go, because we have seen, at least last week, there was a broad-based sell-off over concerns about the Delta variant spiking around the country. We're hearing about the mask mandates that should be reintroduced. There's concerns over the back-to-school season. How do you see that weighing right now on investors and perhaps even the markets?
Well, it was a scare. Here in Los Angeles, we all of a sudden had to wear masks in public places again inside. Not something that people want to experience in the course of the summer when everything seemed to be reopening. I wish I had a crystal ball. I wish I could tell you where things are going. But right now, it's changed, I would say, dramatically from a week ago. People remain optimistic, however, cautious. I think as we get back to going back to school in September, everyone's keeping their finger on the pulse. It's not shaking the market too much. Obviously, today there's concerns not about earnings, because earnings continue to exceed expectations. It's more about the saber rattling that we're seeing with the U.S. and China. And China-related ETFs are taking it on the chin today as well, as you all know.
All right, we're going to have to leave that there. Tom LYDON, CEO of ETF Trends, thanks so much for stopping by.